It's worse than they say. Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, welcome back Sam, who's been looking at some action that we've been having in the markets sort of overnight and quite recently, and it's not looking very good. So how are you going today, Sam?
Good, Chris. How are you doing?
Yeah, I'm well. You really sort of sparked a little bit of a fear in me looking at what you put in the news today because it highlighted a few things when I looked this morning. I went, oh, okay, the S&P really had quite a shocking night. So what happened to all the good news? It seemed like everything was going quite well, and now this.
Yeah, well, we're supposed to have a soft landing. You know, the central bank's supposed to save us. Everything's supposed to be fine. We're supposed to be in another bull market, no problem. That's what some articles are saying. Well, there was some good data that came out, and that's what some analysts are saying. Well, good news is still bad news, but that non-manufacturing data, it came out a little bit later than when the S&P started tapering and started withering over like that, and then only after some data came out, it had a further fall. But what you could see last month is a hard rejection from the 4596 level. So back in August. And when it got rejected from there, it fell on a pretty aggressive path downward, and it's not had the same bounce back up. So it's been having a real struggle going back up the same way it came down. And that just looks like there's fear in the market finally. There's finally a bit of fear where people are asking, is this really a bull market? Now, that doesn't mean it's not going to go up again and retest the 4596 or potentially break it, but that shows that there is investor fear entering the markets in a big way.
And such an interesting point that you're raising there, because when you say good news is bad news and bad news is good news, at some point that sort of needs to really turn around and actually be bad news is bad news. And we haven't seen that for so long. And maybe that is what we start to see going forward. But there's been a lot of news gloating about US dollar strength. So is this one good takeaway that we can take from this, that the US dollar is strengthening? How do you look at that?
Well, I guess if someone's holding a lot of US dollars and not looking at gold or anything else, then they might feel good. But US dollar strength, I mean, during when the bull market ended and everything was falling, pretty much the only thing people were looking at as a negative was spikes in the US dollar. It became one of the biggest indicators. And now there seem to be a lot of positive headlines about, US dollar strength. Well, that's not necessarily a good thing. I mean, it's good for a currency to be strong, but for the right reasons.
Yes.
And if you look at what's going on with rising interest rates and people struggling, what happens is people pull money out of investments. Now, when you pull money out of an investment, say you go to Wall Street and you say, I want my 1,000 Tesla shares out, I want to cash out. What do they give you in return?
US dollars.
Well, yeah, they don't give you shark's teeth or, Japanese yen. They give you US dollars. So if people are pulling out of investments aggressively, that creates competition for the US dollar, hence spikes in the US dollar. We've seen the US dollar index going up for over a month. It's been going up. And then in the last few days, it started spiking. So you see really aggressive green candlesticks shooting upward.
And that caught me off guard, sort of looking, because I was watching the US dollar fairly closely, and it was really approaching that. I've got the chart up here, a dollar and like 104 level, sorry, 104. It was around that level that it looked like it was going to roll over and things would be good, but it exactly as you just described, it's broken through there quite aggressively, and you are seeing those really big green candles coming out there, and yeah.
Yeah, that's what people have to think about when they think about money's going to somewhere. Where is it coming from and why? So that's a big factor.
Yeah, and particularly in that case, it's not breaking out on fundamental strength, because if anything, it should be weakening, right? Like it actually should be, because there's all this debt issuance and there's a lot of issues going on with where the US dollar sits relatively to the rest of the world. There's a lot of issues there, but I completely agree with you on that, what I'm looking at with it shooting up is on the back of the wrong reasons. Slightly changing topic, but last month when we were talking, we covered copper and what appeared to be a bullish breakout there. How did that pan out?
It didn't. So it didn't pan out well. We went through a couple of different charts because there were one or two articles claiming that copper is going to take off, and that's a sign that the bull market's back. Well, it was a false breakout, and one only needed to look at a couple of different time frame charts to see that it was a false breakout, and it capitulated. It fell below its trend line, and then recently it just got a major rejection. It tried to come up from the bottom and it got rejected back down again. So very, very bad news for copper. As we know, copper is the industrial powerhouse metal. So if people aren't making things, they're not buying copper. And we can see copper's really struggling, which is a terrible sign.
And you were referring to it at the time as Dr. Copper, I think, as well. This idea that it really does give us a forward indicator, and for that to be rejected, like you just said, that's not good at all.
Yeah, so it's called Dr. Copper by technical analysts usually because it's just an early warning sign. And to think that, things are almost over and the Fed's about to pivot and all these things, well, businesses know a bit about what's going on economically. Their livelihood, their billions is staked on it, and they might know more than you or I do. And if they're not buying copper, if copper's falling, that's a very bad sign.
Yep. So lots of bad news. And I suppose to wrap this up, is there any light at the end of the tunnel? Is there any good news from what you've been looking at, or is it all just pretty much doom and gloom here at the moment?
Well, the good thing, what I was talking about before, like with US dollar going up in value, where's money coming from? So if things are losing value, investors frantically look for somewhere to put their money where it's not going to sink. Yep. So if multiple ships are sinking, everyone's just looking for a ship that's not sinking, or one that's going to come up that they can put their money on. That not even if it'll go up, but at least it'll hold its value. Now, after the GFC in 2008, silver specifically, because it was held down so much. After the GFC, silver had a roughly 370% rise in the following 2.5 years. So that was a situation that caught a lot of people off guard. People thought the economy was going to be fine, up forever, and then, something broke, and they had to scramble and look for somewhere to put their money. And silver was a big place to put it. Now, the marker for that event, very, very interesting marker, was a 9.2% rise in one day.
Wow.
So after the GFC, silver just had this wild spike upward. If you think about 9.2%, that's, if someone said you made 9.2% on your investments this year, you'd say, wow, that's great. That's a great year. So think about one day, you check your silver portfolio and it's gone up 9.2%. That's a pretty preposterous rise. And what that can come from is, well, it can come from a bunch of small investors piling in, or it can come from a few big players who know what's happening and want to get into the market before it goes up. Now, what did we have late 2022? Well, we had a similar candle. It was an 8.9% rise in one day. Again, very, very strange. Because silver only typically moves a fraction of a percent. Yep. So an 8.9% rise in a day, and the pattern afterwards, so the pattern from then up until now looks just like the one, or almost exactly like the one that happened after the GFC. So there's some potential positive news, and that positive news just comes from, look, everyone is trying to make money for them, and if something's falling, if equities are falling, they want to take it out and put it somewhere that's not falling.
That I really love that example. Particularly highlights to me this idea of patience, for starters, that even during this period, you only get those big explosive moves upwards out of periods like this. So that's really important. But the other thing I just took from what you were saying is how important it is to be in before the 9% move. That's always the difficulty in these markets, because I know, and I don't know this statistic directly off the top of my head, but I know there was a lot of research done on only several days in a trading year resulting in most of the returns. And if you miss those days, you just miss out. And people who try to chase the market, by definition, miss those days. So they come in after the 9% move, trying to, hoping for another 9% or whatever. Whereas often those critical moments in the market are where you book exactly the description you just made, where you book your profit for the whole year. So yeah, that's just stuck with me from what you're saying there. It's better to be, a month early than a day late, I suppose.
Yeah, well, you've seen a lot of the dollar cost averaging, that term has been taking off a lot more recently because people find out the hard way. You watch the chart every day, spend thousands of hours and so much energy and stress and, losing hair, and then you miss what happens. Whereas if you just stuck in, you wouldn't miss it. Now, the thing about this 9.2%, though, that's not included in the overall increase. So after that, it did continue to go up almost a 4x.
Yeah.
So it's
well, there was still, and that's, I suppose, the other side is people go, oh, I can wait because you look at it kept going. But I just think it's so important what you said about dollar cost averaging as well. This idea that you have to be in the market to make those gains, and so many people. I mean, we've seen it, and you would have seen it in Melbourne office as well, time and time again. After the big gains, everyone comes rushing in. The smart money shows up before the big gains. That's just always the way it is.
And it's the hardest time to invest as well. It's always the hardest time because interest rates are high. People are feeling the bite. Something happens, the car breaks down, hours get reduced. It's a little bit harder to make investments at that time, but those who do get extremely rewarded because there's low liquidity and the price is cheap. So
yep, that's exactly right. Yeah, and it kind of makes sense in that big picture. That the market is always trying to make a fool of as many people as possible. It's always the hardest to make your money by being in there at the time that the market makes it difficult. It doesn't make it easy. Otherwise, everyone would be probably rolling in cash, I suppose.
Mm-hmm.
Well, Sam, thank you for all that today. A great insight, a very depressing insight, but great nonetheless. Appreciate your work on that.
Thanks, Chris.
Thanks everyone for watching. If you've got any questions or comments, reach out on those social platforms. That's us for this week. We'll be back on Tuesday next week with Alex to discuss all things markets and metals. Until then, have a great rest of the weekend, and we'll see you next week.